Well, we got some fairly important election results in, and we've had the market chopping around quite a bit. But actually, we're going to talk a little bit about synthetics. We're going to talk a little bit about skew and take some of your questions today on Open Interest. Hello, everybody, and welcome. Welcome to Open Mic. I'm Mike Coe, and on my screen right now is a chart of skew in SPY for January of 2026. For those that don't know, what is skew? Skew is basically, from an options trader's perspective, what we're talking about is the difference in implied volatility of different options strikes. So as we look at this, I'm going to just make a little notation right down here. And this is the at-the-money strike. So you can see over here where it says 100%, or maybe you can see it. It's probably fairly small font. It's not really terribly important that you can read the font. What is important is that you understand that this is the implied volatility, the price of options for the at-the-money strike in SPY. This is a fairly standard characteristic. We call this, some people call it a volatility smile, because you can see that it's sort of shaped like one. Others will call it a smirk, which probably makes more sense because you can see that the downside puts, those are the prices reflected in implied vol space down this way, are much higher than the upside over here. What these options prices reflect are two characteristics that options traders anticipate. The first is the general sense that people like to buy protection, and that will elevate the price of downside puts. The other is the idea that volatility tends to increase and you exhibit more price jumps, non-continuous pricing, when security prices fall. There are other dynamics too. We've talked about them a lot on this channel. For example, issues related to balance sheet leverage, things of this sort. When people just talk about it in plain English, sometimes you'll hear things like stocks take the stairs up and the elevator down, that kind of thing. So the notion is that prices move up steadily, they move down suddenly. Regardless of whether all of this is true or not, it does create some interesting dynamics when it comes to options pricing that people might not realize. So, for example, it makes buying put spreads more attractive. It makes them more attractive because if you buy a put spread, let's say I buy a very close to at-the-money put, like this one here. So this one's 2.5% out of the money, expiring in January 26, and I sell one over here. You can see that what's actually happening is I am selling an implied volatility that is higher than the implied volatility I'm buying. And the net effect that a trader will see when you do this is that the amount of premium you spend as a function of the distance between those strikes, in this case, 97.5% and 90%, so that's 7.5% of the price of the underlying, will be smaller because of it. Obviously, if this was a flat vol, so these were the same, like this, and I was selling this one down here, I wouldn't collect as much for it. And therefore, the amount of premium I would be spending to buy that put spread would be greater. Similarly, if I sell an upside call spread, so if I sell this option and I buy this one, because I'm buying the lower implied volatility and I'm selling the higher implied volatility, I will collect more as a function of that differential. And the way this plays out is it can create some interesting situations. Now, I have seen circumstances where, I think this happened in late 2017, for example, one could sell, for example, a 5% out of the money put, which was a very high implied volatility, and buy a 5% out of the money call at a very low volatility. And the ratio was that you could sell one put and buy 3 or 4 of those upside calls. So you had a very asymmetric risk-reward relationship. Now, a critic of a strategy like that might point out, well, the chance of it moving suddenly down 5% is greater than it moving up by a like amount because of that dynamic that people expect, which is that it will climb slowly upwards, but it will fall downwards. Okay, well, it is possible to set something up such that, and I've done this here, let's just imagine that you have a portfolio and you're saying to yourself, things feel a little bit stretched. I'm getting anxious. I've observed that maybe the political dynamic doesn't seem that friendly for risk assets. You know, there seems to be a swing towards more socialist policies, and maybe you feel good about that. But if you don't feel good about that, and you're also saying to yourself that stock prices have risen quite considerably, that valuations are above average, which they are. Not saying that that's not justified, but it's just a reality. We can demonstrate that quite easily. I want to sell some upside, and I want to buy some downside. Now, we talk about very simple trades to do hedges, like put spreads all the time, and we sometimes will talk about call credit spreads on the call side as well. But I have this example. So if you had SPY, you could sell, for example, a January 700-725 call spread, and you could buy a 670-635 put spread. And at the mid-market anyway, that's about a $27 credit to do that trade. Now, these options are only about a penny wide apiece. So, even if we just said, okay, well, you can put that trade on at a flat price. So you have no net debit, no net credit, which is probably quite realistic. Because that's about even if you had like a 2-3 cent spread per option, even times 4 legs, you're probably looking at a bid to offer spread that's in the neighborhood of no more than 9 cents. Okay. Well, notice something about this trade, and I'm going to illustrate this in a second, but the first thing you're going to notice about this trade is that the put spread I'm buying is $35 wide, and the call spread I'm selling is $25 wide. So I'm collecting money by selling an upside call spread that is narrower than the put spread I'm buying. Notice something else. The put spread I'm buying is struck at 670. Okay, so 670 versus today's closing price of 677.55. That is 1.1% out of the money. The calls, on the other hand, are 3.3% out of the money. And the net effect of this is that asymmetric risk reward. Now, I can't actually show it to you in options play because options play by default limits you to 4 legs. But one of our own proprietary applications does not do that. So I'm just going to pull this chart up and we can have a look at it. And you're going to see what it is that I'm talking about here. So if you take a look at this trade right here, which is long SPY, long that protective put spread, selling that call spread, I don't know how well you can make it out, but this is asymmetric. You have more protection to the downside and more participation to the upside. So this is one of the things that skew can afford you when it gets steep. I'm not saying it's super steep right now. I don't think it is necessarily. But I'm encouraging people to take a look at this because hedging as a habit, so always buying puts against your long stock, you notice that I don't typically do that, even if I do feel some concerns about market valuations. I don't promote that as an activity. And the reason is because of the volatility risk premium. What's the volatility risk premium? Volatility risk premium is essentially the incremental cost of the insurance costs over probably what its fair value is, right? So there is a premium to that. In the same way that when you buy car insurance, you are probably paying more than its expected value. You don't just buy car insurance and pay a price saying, well, there's a 1 in 100 chance that I get in a crash and then it'll be a push. You may have a 1 in 100 chance of getting into an accident that requires you to make an insurance claim. But the truth is that the value of that claim is likely lower, even times that probability, than the premiums you spend. And the difference are the profits and the expenses that go to the insurance company. In the options world, that's the volatility risk premium. It is essentially the cost above the expected value for these options that the market demands for selling insurance. This is also one of the reasons why we don't mind doing call overwriting strategies. If they were always at expected value, there would be no benefit to doing that. It's the reason why we like selling cash covered puts. Sometimes it's good to be into the insurance business as the house because there's a little bit of edge in it. But what you'll observe is that you can structure purchases and sales of insurance in such a way that the risk-reward relationship is on your side. Now, I'm going to say that this is a fairly, in this particular trade, the benefits are fairly modest. I mean, we're talking about, 3.3% that you could make over the course of 70 days. That's when this trade would expire, plus any anticipated dividends. Let me see what the SPY dividend schedule is. And it doesn't pay a lot in dividends, right? It's less than 2% annualized yield. So even if there is a dividend in here, it's not going to be that large. There is one. It goes X on December 19th. And the forecast dividends, we'll call it $2. So let's go back to this for a second. What that means also is that this put, which is $7 out of the money, is really only $5 out of the money because you're going to collect about a $2 dividend. So that's 5 over 667.5. That put is very close to at the money. Very close, right? It's 74 basis points out of the money to the downside. So, for most people, maybe you're saying to yourself, do I want any amount of equity market risk to be taken on for, a relatively modest return over the course of 70 days? That's kind of up to you. This is, like I said, 3.3% to the upside plus the $2. So that's another 30 basis points. So you basically would have, 4% upside, almost no downside. And if it really moves if it moves 10% up, you'll get more participation to the upside than you would lose if it moves 10% down. Asymmetry. We like this. And the other thing we like is that stocks generally rise. Right? So on balance, not a bad trade. Exciting? I don't know. 1.25% per month. Depends how exciting you think that is. But that's about what that works out to. Okay. What got me thinking about this was this little segment that I saw on CNBC, and I think we can play it from somebody who is very close to the freight industry, just talking about what's going on in the economy these days when everybody's focusing on AI. Maybe we can pull up this video.
Well, we should be worried. The goods economy, certain portions of the goods economy are collapsing right now. So year over year trucking volumes, this is really the predominance of freight that moves across the United States, is down 17%. It's important to unpack exactly what we're talking about. Is the retail freight, freight tied to the trucking market, which is really local distribution, is actually flat. So it's not seeing deterioration. It's probably why the Federal Reserve isn't overly concerned, because the consumer is staying pretty persistent. You see it in a lot of the retail earnings. But when you look at the industrial sectors, the folks are the freight that moves over the long haul. This is energy, automotive, housing, and manufacturing. We're down 30% year over year, which is very great financial crisis levels of concern.
So, I think ignoring these types of things, we do this at our peril. Now, he was talking about freight. The transports are a bigger sector than just that. So transports are going to include, for example, passenger airlines and things of this nature. But it was an adage for Dow theorists for quite some time that kind of as go the transports, so goes the industrial average. The logic being that the industrial activity in the market is going to be marked or measured by essentially the transport activity. And I think there is some truth to that. Now, our economy is not an industrial economy so much anymore, but I do think that it is important for us to remember that. And I'm not sure whether it was in that specific portion of, because he actually spoke, and you can go on to CNBC's website and find that segment. It's several minutes long, and I'm not sure whether he mentioned it in that portion, but the number of people that are employed, even though we are not as industrial economy as we once were, is much higher in manufacturing than it is, for example, in AI, right? And it's not a close measure. We're talking about, I think he had said something like 35 million people instead of 2 million. So, it's a substantial number, a factor of 17 or so. And that affects things like consumer confidence, and GDP is 70% consumer driven in the United States. So if you start to see weakness in an important part of the economy, that will tend to conflagrate a bit. And I think that's well worth mentioning. So it was in that context that I thought about this trade. You can play with the strikes yourself, but know that it doesn't have to come at a cost. You can put on SPY put spreads financed by the sale of some upside options. Now, let me give you another example of something you can do, and I can't really model it out in just one cute little chart like this, but let's just say that you have 15 or 20 stocks in your portfolio, and that when you look at your portfolio's performance, it tends to track the Qs, the Dow, the Russell 2000, the Russell 1000, SPY, whatever it is. Whatever you find that it is most closely correlated to, you could, of course, always consider buying a put spread on something like SPY, and then selling call spreads against those individual stocks, and doing so in a way where, at the very least, you're not laying out any premium. Maybe you're actually collecting a little bit on balance. And because of the dynamics of skew, there's a good chance that when you do this, you're going to end up with a portfolio that actually has a fairly favorable and asymmetric risk-reward characteristic. So, and if somebody wants to go through examples of this, we can certainly do that. But I just thought that was kind of an important thing to talk about. Okay, so Jim Howard's got a question for us, and it looks like you asked it twice. I'm going to take the most recent version of it. Mike, when the government reopens, do you think it might substantially propel some stocks like restaurants or other stocks, cruise lines, auto sales? Thanks. And there is a portion of this, or maybe not. It looks like it gets cut off. I see an ellipsis at the end. So I have been seeing, I've been seeing some commentary suggesting that foot traffic in places like Las Vegas is down considerably. Last week, ahead of McDonald's earnings, which just came out, I had pointed out that the valuation was maybe just a little bit higher than it had been, and I actually suggested a cheap put spread going into McDonald's. That proved to be unnecessary, because McDonald's actually is higher. Now, is McDonald's a good proxy for every other restaurant? It is not. What is interesting is that part of the reason the stock is higher is, well, there's two things. One is trading down, and that is that there are people who are going to things like fast casual and other types of restaurants like that have traded down to McDonald's. The other thing is that, according to management, they've seen a big uptick in traffic and sales as a result of aggressive value pricing. So what does this tell us? It's not like this is the only sign or symptom that we have, but it does feel as if a good slug of the U.S. consumer base is pretty stretched. So over the course of the last couple of weeks, we've talked about how households' forecast spending going into the holiday season is lower this year than it has been in years past. We are seeing higher delinquencies than we have in years past. Yeah, Tucker D Dog says aggressive value pricing. Is that a direct quote? I think so. Undoing aggressive value pricing, undoing the overly aggressive value pricing increases. Yeah, I see. So, I mean, I guess it depends, where you are. I can tell you that there is a McDonald's that's not that far from me. I don't go there very frequently. But I have certainly observed that prices at restaurants have gotten to be, extraordinary. I have no idea what a Big Mac costs near me, but I know that it was in the news that there's a McDonald's in Darien, Connecticut. It's on I-95. It's just northeast of New York City. And I remember that I saw an article that was talking about the price of a Big Mac and a Big Mac value meal at that particular restaurant, and how it was quite incredibly expensive. So many orders of magnitude more expensive than the price of a Big Mac when that sandwich was first released. The short version in all of this is that I don't know that the government reopening is going to substantially propel these things. I will say, though, that some of them have been hit pretty hard. Let's take a look at Chipotle. So this is an example of one that's been hard hit. Their earnings came out, and you can see right here just how hard hit it's been. And one of the things that the management spoke about, so this is just a one-year chart. It's down 52% almost in less than a year. And they spoke about the fact that they felt that consumers were essentially out of bullets, out of money, and that it was impacting their sales. And I don't know how you can see that this is a trend that long preceded the government shutdown. So yeah, Tucker D Dog says it's $18 for a value meal for one person at the McDonald's close to Tucker. That's not cheap. That's not cheap when you think about it. So I'm not expecting that to be a really big shift. The other thing is that with respect to auto sales, the auto sales picture has been degrading again for a considerable period of time. I'm quite sure we've discussed auto loan delinquencies on this channel many times before the government shutdown took place. Did that help? I'm sure it did not. Will reopening the government help things generally? I'm sure that it will. But can it correct the fact that we have record delinquencies? Delinquencies defined as auto loans that are more than 60 days in arrears? No, there was something else, which is that the amount by which the average car loan was upside down, that is to say that the debt exceeded the equity in the car, was also at records. Now, part of that is a function of a couple things taking place. Car prices accelerated rapidly, much more quickly than median incomes did. So the median car price went up very sharply relative to median incomes. Then as interest rates rose and as car prices rose, they started extending the terms. It's interesting, I get these pop-ups all the time. I'm sure all of you do too. You're perusing things and car ads come up. And, I can remember when 3 years was a standard car loan. Back in my days when I was in college, I think 36 months was a standard. A longer-term car loan was like 48 months. And then they went to 5-year loans, 60 months. When I was a kid, I don't think that people really thought, I grew up in the Northeast. I don't know that New England is considered part of the Rust Belt, but the Rust Belt so named because in the wintertime they put salt on the roads and cars had a tendency to rust out. So if one bought a new car and call it 1980, when I was still in middle school or grade school even, I guess, that car probably wouldn't have been expected without some pretty good rust proofing to last a whole lot more than 5 or 6 years. And so it's kind of hard to imagine that essentially you would buy something and you would have a loan that would last for as long as the underlying product would. Now, a 72-month car loan is not unusual. Now, the average age of cars on American roads is also at record highs. It's in the double digits now. It's more than 11 years, I believe. But these are the kinds of dynamics that take time to build and they take time to grow out of. And I think this one will. You combine all of these factors. And the other thing I would add to this is that, at least from what I can see, it does look like dealer inventories are building. There was a real acceleration of purchases that we saw in Tesla's most recent sales numbers, but that was propelled mostly by the expiration of the EV tax credits. So a lot of people were trying to get in under the wire and get their Model 3s and Model Ys while they still would get a $7,500 federal tax credit. Now that that's out of the picture, that was an artificial sort of boost that now is going to take a little bit of time to bleed off. So while I do hope the government reopens quickly, things will be better once it does. I'm not expecting a huge boost on the consumer side as a result of that. Michael Kane says, do you feel that Microsoft, Google, and Amazon are pricey and investors should wait for a pullback, or if they like these stocks, buy in now? Thank you. Google and Amazon, I've said many times about both of these, I don't think they're expensive. They're more expensive than they were. Google is more expensive than it was at the beginning of the year when I made it part of my acronym amongst, my sort of top ideas for the year. It was in the Rising acronym that I put on CNBC and on this channel. In fact, the only difference between the acronym I provided for CNBC and the one I provided on this channel was that we had double G's, right? So we had RSP, we had INDA, we had IBIT, SCHH, and the two G's in the one here. Nance was the N, N-A-N-C. And then we had G for Google, Alphabet, G-O-O-G-L. The voting shares, I think, was the one I referenced, and GLD. But it's not expensive even now. Let's take a look at why. So what was weighing on this thing was that they had the antitrust concerns, and there was this issue that they might have to divest Chrome. Thankfully, they didn't have to. I think that would have been outrageous if they had needed to. But, just take a look. So we're looking at $11.84 in full year adjusted EPS for next year. So that's 24 times forward earnings. And that is with a take a look at, by the way, what the company's doing. It's still forecast to have $66 billion in free cash flow. And that is with a massive CapEx. And also very solid top line growth. So is it cheap like it was? I thought it was definitely cheap. It's not cheap, but it's not expensive. So that's my feeling on that. Let's take a look at Amazon. Similar story. Also a huge build out, massive CapEx forecast for next year. Even bigger, in fact. But again, so what are we looking at? $250 share price, $9.45 in adjusted EPS. That's 26 times. That's about a market multiple with 11.2% top line growth. Very good free cash flow growth as well. So it's growing faster than the S&P. It's highly diversified. It's in all the right places. So I don't think it's expensive relative to the S&P. I don't think it's expensive relative to Walmart, right? So I constantly hear people saying, "Oh, well, Walmart could digitize. Walmart could, that's the big story is that Walmart could become another Amazon." Well, that's interesting. Why do I want to buy the company that could become Amazon for 35 times earnings when I could buy the one that already is Amazon 5 turns cheaper? That doesn't make much sense to me. I think Amazon relative to Walmart, I think Amazon relative to the S&P is very reasonably priced. Amazon also, by the way, has Prime Video. So you could kind of think about it, some of the parts if you like. You could take their AWS business and say, okay, I want to compare AWS to Azure and Google Cloud and things like that, and what kind of a multiple does that deserve? I want to take their retail business and I want to compare that to the Walmarts of the world. I want to take Prime Video and I want to compare that to the Netflix of the world. And, no matter how I divide it, it's like each of the pieces is cheaper than any of their comps. It's cheaper on a growth basis relative to the S&P. So I think Amazon's also still fine. Again, not as cheap as it was, but it's not massively expensive. Let's move on to Microsoft. So Microsoft is pricier than these other two. It also is remarkably steady, which is one of the reasons why it tends to get a premium and arguably deserve it. So let's see what we have here. 1877 is the forecast for next year. That's just the average of all of the guys that cover it, guys and gals. Actually, that's not bad. I actually thought it was, off the top of my head, if you'd asked me what the multiple was, has this thing pulled back? I was just looking at this not that long ago. Oh, it has pulled back a bit, I see. Yeah, it's just a couple of weeks ago I was looking at this and I was like, north of 30, but it's below that now. Yeah, it's actually trading 27 times forward with, mid-high teens growth rate. So, once again, not terribly expensive. I would say that I'm not crazy about what the stock is doing price-wise right now, certainly relative to the S&P. It's given back a bigger percentage. And where's the 150? That's what I want to keep an eye on. Use that as a longer-term trend. I think it's well above it now, but I think this is kind of what you want to keep an eye on. So that is, what are we looking at here? It's down about 5% from here. So again, not expensive, not cheap, not expensive. Actually reasonably priced relative to the S&P, certainly given its growth rate, I think. Yeah, I mean, this sort of goes to what I was talking about last week, I think on this channel and also on Power Lunch when I was on with Brian Sullivan at the San Francisco office for CNBC. And that is that I hear a lot of people complaining about valuations. And if their concern about valuations is that these companies have become very valuable, I'm not sure that's a reason to sell them because something has become very valuable. That happens. Sometimes you get something that is a standout relative to everything else, and it becomes very valuable. Is it overvalued? Is a different question. Is one of the 36 Ferrari 250 GTOs that were made in the 50s and 60s, are those things overvalued at their current price? They have become very valuable. I don't know that they are overvalued just across the whole landscape. And I think that is true here too. I think it is also safe to say that if the market kind of rolls over, that these certainly will too. In fact, the market will roll over because these things decline. And the reason I say that is the names that we've just discussed disproportionately account for the performance of the S&P in recent years. If you take a look at, the bottom 450 stocks in the S&P 500, or even everything outside of the Mag 7, their performance has grossly lagged the likes of Amazon, the likes of Alphabet, the likes of Microsoft, certainly Nvidia, certainly Netflix. These are the companies that have incredible margins, better than average growth, massive amounts of free cash flow, and on top of that, people are buying these things because that free cash flow affords them the ability to make the substantial investments into what everybody thinks is going to be the next big thing in the economy. Now, I would make the point that How much that translates into profits remains to be seen. But the existing businesses that these guys have means that even if they're screwing up, even if some of these investments are too much, right, and they're not going to get back out of it what they're putting in. In the scheme of things, it's shockingly not that big. These are multi-trillion-dollar companies, so $100 billion is a big mistake for any business to make. But on a relative basis, for Microsoft, for example, if that's what it proved to be, it's not that big. Next year's CapEx is 111. Well, let's go back in time and say that $30 billion in CapEx is sort of a standard run rate x the whole AI picture. So that means take 100 and, call it 110 less 30 is 80. So let's just say that incremental 80 billion in capex is money that's just essentially getting lit on fire. Well, 80 billion on a 3.8 billion dollar company. They for lack of a better word, if any businesses did in fact have money to burn, I hope that's not what they're doing, but if they did, it's these guys. So yeah, that's when you take a look at the S&P, and this actually goes to that earlier question too about the transports, which is that when you take a look at the S&P's valuation, it is a little bit stretched, but there are some other companies where the valuations seem a little bit harder to get around. I continue to struggle with the valuation of companies that I actually like. I mean, I like Costco. I don't like the valuation. I think that one's expensive. But I've thought that for a long time, and it has just continued to sort of linger at valuations that I have a hard time getting my arms around, so I don't encourage people to buy it. But and as the company gets bigger and is therefore a larger constituent in the index, it's going to weigh on the multiple that the index has, more and more. Walmart, another example, very big company. Therefore, its multiple has a larger impact on the multiple of the S&P than Target does, than BJ's does, and stuff like that. Good company. I don't shop there, but it seems like they're doing a great job operating. They have a natural bid under the stock because the Walton family controls the Lions share of the shares, and they don't sell. And in fact, they were net buyers for a long time. So, I get a little bit anxious about the S&P broadly, but I'm not as concerned about some of these stocks, which seems bizarre, right? But these companies are kind of, they're proving their worth, if you will, and thus far been justifying their valuation. Same thing's true for NVIDIA, arguably. Okay, let's see here. Finwest, hi Mike, getting used to the time change. You're on at 4:15 a.m. now. Oh, that's tough. You're asking whether I've used the forecast trader platform at IB. I have not. I think all of these platforms, to remain relevant, are going to allow people to bet on and gamble on all kinds of things, not just stocks and bonds, of course, including things like elections. IB and every other platform are going to have to do this just to compete because the hoods of the world are going to do that. But I haven't used theirs. Matt McDonald says, I've been selling 30-day 10 delta strangles on various high implied volatility ideas post-events, and it seems like a good wait and collect strategy. Any thoughts? Yeah, I do like that. And I have mentioned before, this is something that Carter Worth does and has done very effectively now for a couple of years. Worth charting subscribers, if any of you are among them, will know that he puts out this regular piece that he calls "You've Been Strangled," and he highlights that. And this is exactly the setup that he looks for. He's not interested in selling into catalysts because anything can happen. Instead, he likes to sell after a catalyst that has moved a stock very sharply. The idea being that a reset has taken place in the price, A lot gets sort of priced into that move. Oftentimes, volatility doesn't fall that much after that happens. Sometimes it even goes up because of the incremental anxiety. And I've talked about strategies like that myself. I did so in Meta earlier this week. And so I like that strategy. 10 Delta, 30 days. Let's take a look at how that prices out. Let's pick, I don't know, something Palantir. They just announced. So we haven't looked at this. We're just going to look at it cold. Palantir is a high volatility name. They just announced earnings. And so here we are. So that catalyst is behind us. Let's just take a look at will spending increase when government opens? Let me see here. DoorDash bashed. Carter going to make a play after. DoorDash. Okay, so that's interesting. All right, we're going to look at DoorDash next. I already pulled up Palantir's. So we're going to. Perfect. So we're going to look at DoorDash, but first we're going to look at Palantir. So Palantir had earnings. It's really interesting because there was Alex, Karp was making a fuss about the stock's performance after they had, what a lot of people described as blockbuster results. Companies trading more than 100 times revenues, right? I don't think anybody could make the case that investors are discounting the company's potential too aggressively. So let's start with that. But okay, the stock has fallen. The news has come out. It's a high vol stock. So let's take a look at it. So you're just going to sell a strangle. In your case, you're looking out 30 days. So we'll come as close as we can to that. Here we are. And you're selling a 30 delta put. 10 delta put and 10 delta call. Well, let's take a look at the returns you get for 10 or 11. That would be the 155s. And the 235s. So you're getting $3.17. That's if you hit the bid. 332 at the mid. Let's call it 3 1/4, just for fun, versus 187.90. So you're collecting 1.7% of the current stock price in 30 days, or a 12th of a year. So that's more than 20% annualized rate of return, which I think is very reasonable in an equity context, and probably reasonable in a stock like this, because the downside risk that you have here is that you're going to get long the stock at 155, less the premium you collected to do the trade in the first place. So that means you're going to get long the stock down 17.5%, or in this example, you're going to get short the stock again plus, up 25%. So, yeah, I think that's fine. And everybody's mileage may vary. I probably would be using slightly higher deltas myself. 15, 16 delta, maybe even sometimes 20. If I really like the stock, I tend to bump the put strike up and take the call strike up a little bit, because stocks go up more often than they go down, because I might have a valuation thesis where I'm fine just owning the stock anyway. A quick point. When you're looking at these stocks, be cautious that these are stocks that are unlikely to be acquired at a material premium, because that can happen. What you'll sometimes see is, if a company is weak and is starting to get cheap, and then the comps start sort of circling a little bit, you have that possibility that a catalyst that's not on the calendar comes along. Like Kimberly-Clark says, hey, we want to own Kenvue. We don't want to just sell Kleenex. We want to take the pills that the guys are popping when they're using Kleenex. Cover your bases. Stuff like that. Okay. DoorDash. That was the other one. Let's take a look at DoorDash. So the struggle here is that we've got this news out, but we're not really going to know. Let's take a look. What what whacked this thing? So they reported 67 cents. Is that what was the street looking for? No, it can't be that far off. Looking for $1.30? That would be a pretty substantial miss. Hang on. Yeah, this street definitely thinks that's a pretty big miss. We'll call it 193 versus 238. Stock's down 20%. Let's take a look. What's their balance sheet looks like? Still have net cash. So this is now an $80 billion business, at least where it's priced after hours, with 2.4 billion. So that's, even here it's trading 33 times unadjusted forward earnings estimates. But look at that. I mean, I don't know what their free cash. Let's take a look here. Let's just blow this out from the quarters here. What happened to their free cash flow? Oh, it's not in here yet. Hang on. Let's take a look. So we are going to see whether that was in their, see if it was in their press release. Because it didn't flow through to Bloomberg yet. So unfortunately, we're going to have to do it this way. Orders increased by 21%. Revenue is up 27%. GAAP income was up 51%, but that was $244 million. So GAAP earnings, $244 million. So this is an adjusted number. And what about cash? What about cash? EBITDA, that's nice. Up 41%, 754. What is the free cash flow? Let's find it. I apologize, you guys are sort of dealing with me fumbling around here, because normally free cash flow. So, oh, they want to maximize free cash flow. Great, that's what we all want. Don't just, but how did you do? How did you do? Okay, 723 million. Okay. That's actually pretty good. Makes me believe that 836 is achievable. But let's just annualize that number. Is 3 billion over 80. So that's 3.75% free cash flow yield. It's not bad. That's just annualizing the number that they just reported. It's not in here because it should be right there, but Bloomberg hasn't put it in yet. So this might be a candidate for this strategy, because this is more likely to happen when you get a real disappointment that the stock gaps down and that there remains a bid for implied vol. So this one's probably likely to have a pretty high implied volatility tomorrow. And let's see where the stock is. It's trading 193 here. Its recent highs were 280, which would have been resistance anyway. And what was implied vol going out, call it a month? 60. Okay. let's just draw a line, and we'll play a little game. Okay, we'll work through this. Let's assume it does not fall back to its typical post-earnings result, which would be down here. So I'm going to draw the two lines. The lower of these two lines, the red line, is kind of your base case post-event. So these bumps that you're seeing, that's when earnings come out. This is where it was right here. This is where it was this afternoon, 1 month implied volatility, because we had this catalyst. Let's just split the difference and say that, okay, I think it's going to be about 45 vol tomorrow. And let's use 195 as our expected stock price. And let's model this out. So we're going to take we're going to look at a two-leg, 30 days to expiration. So I'm just going to put 30 days. 30 days. So the volatility assumption here is 45 that I'm going to use. On the downside, so this will be a put. That's going to be a call. I'm going to be selling both. I'm going to use $195 as my stock price assumption. And I need to introduce a little bit of skew here, which is what we started talking about, right? So let's say that I can sell my upside call for, we're going to call that one, we'll call that 42 vol. And let's say that I'm going to sell my downside put at 49-ish vol. Let's get the Greeks in here. And so I want a 10 delta put. Let's see what we get. Where's that 170? What's that thing? That's 14. That probably wouldn't be a bad one to sell, but let's make it 165. Again, we're really being sort of hypothetical here. So that's about a 10 delta. And on the call side, lower vol, so it's not going to be as far out of the money as this. 30, 25. Let's call that 220. See how close that gets us. Oh, that's actually could be higher. 225. Actually, it could maybe it'd be a lot higher. Get it above the price. Be nice if the break even is going to be on the outside of. So we have here, and there we go. So that's almost completely flat delta. So that would collect 1.32%, assuming. And look, this is total thumb in the wind stuff, but you can kind of figure where I'm going with this. It's entirely possible that the level of volatility stays more bid, especially if it comes in here like a 20% gap. Options markets don't usually just give back vol. You'll get the same kind of vol crush when you get that kind of a move. But even this, which is probably a fairly conservative assumption, is going to get you, probably $2.50, $3 anyway. And that's with a strike that's $30, $30 below the current price. So 165 versus 238, which is where it closed today. That's down 30% from today's closing price. So, yeah, this is going to be an interesting one. We're totally guessing here what the numbers could be, and the stock may rebound after hours, and they're probably having a conference call even as we speak, and as people figure this out, that's going to make a difference. But we will see. Okay. So Capital Fund, is there a percentile chart in Bloomberg for the client ratio of car purchase on dealer finance versus a HELOC? That's not a metric I've ever looked at. So you're talking, I'm assuming, about people who use home equity loans to purchase cars to presumably take advantage of lower rates and things like that. Interesting. I've not seen that. I don't know. I'm not going to fumble around look for it now, but I probably will when we're done. Just as you guys can see, I mean, I'm pretty used to using this thing, so commands to go look for stuff I'm pretty familiar with. But since I've never looked at that, yeah. Okay, KJ Lemur, Microsoft missed on Azure. That's why it got punished. Yeah, I mean, look, people were putting a haircut on AWS too, but and I think it is also very clear that investors are getting a little tired of ever bigger investment in these things and not really seeing how that translates into profits and a bottom line for themselves as shareholders in the company. But again, it's not like these companies are grossly expensive. So, I'm still comfortable with them until they start dropping below long-term moving averages. At that point, I would probably use the 150 as a guideline for that. At that point, I would kind of say all bets are off. And actually, earlier today, I was talking about Bitcoin, and I made a similar comment, which is that it just hasn't been behaving well, right? Today I think it was up a decent bit, but it ended up giving some back. It was up before when I was looking at this, so obviously a lot changed. But you can see right here. I mean, you can see it's below the 200-day. I was going to put the 150 in, but there's no point because the 150 is obviously going to be between the 200 and the 100. So not great, and you just wait for one of these things right here. If it breaks out above the 150, then I think you can get back in. My long-term view on Bitcoin is still positive. And actually, if this breaks out above the 150, I might be inclined to buy Strategy because Strategy is only trading at about a 1.3 times multiple to the book value of their Bitcoin holdings of about 640,000 Bitcoin. And that's the enterprise value. So that's, net debt, net cash. So again, just sort of looking for a little bit of leverage if it comes back to life. But I really do think this 100,000 psychologically it broke below 100,000, got down to 98, I think, right? Was that the low recently? Where's my after hours? So why did I think that? Why did I think I saw it crack below? Did I not? No, it did. Yeah, you can see that right here. I mean, I wasn't watching it tick at the moment that it did, but I definitely saw that it had gone below 100,000. I think that's an important psychological level for folks. And the fact that it's below the long-term average. So if that thing gets back above, then maybe use Misty as a way to take a long play there. It was J.P. Morgan I think they said that they have their view is that Bitcoin could get back up to 160. I think that was maybe a year-end or early 2026 target. And so again, it's not like I'm the only person saying this. It's not a unique insight. Everybody knows the strategy is a slightly levered play on Bitcoin. But yeah, that's kind of my thinking on that one. James Forbin, Meta selling pressure appears to be fading. Is this a good time to consider options into January 2026? The answer to that is yes. I like selling strangles on it. I talked about that earlier this week, skewed to the upside. So taking a net long delta exposure, selling some cash covered downside puts, and then maybe selling some upside calls. When do they, and I think they report, I'm going by memory, let's find out how good it is. I think they report on January 29th, or that's the expectation. Aha! Yeah, my memory doesn't fail me every time. Yeah, so January 29th. But yeah, I do think, but for all the reasons I've previously stated, I think this is a decent spot for Meta. Lean slightly long, short vol. Don't sell through the next earnings print. Pretty simple. Okay. I don't know if you discussed because I was a degenerate day trader, but I noticed Qualcomm today and AMD, pretty decent reports selling off. Not a good look for semis. Yeah, AMD, that was kind of an interesting one, right? But we've seen this before in AMD. Lisa tends to, there's a lot of intra-report hype in AMD, I feel. And I like AMD better than Intel. Actually, producer Jay, who can hear me right now and who I can hear if he starts talking to me, in part because of the things that he has said. I've got a lot of screens in front of me. 1, 2, 3, 4, 5, 6, 7. I've got eight screens, 2 boxes. Remember when we always it was an advertising thing when you bought a machine, Intel inside. So commonly you would buy a Dell box that has Intel inside, maybe an NVIDIA GPU, things like that. And we've been looking at replacing, 1, maybe 2 of the machines that power this and this. And we're looking only at machines that have AMD Ryzen chips in them. And not looking at Dell either. Partially because want a bigger box, want a lot of cooling, stuff like that. Let's take a look at AMD's valuation. Yeah, I rarely jump up and down about AMD because I just feel like it trades poorly coming out of results. It's always... the golden ticket is always just seemingly out of reach whenever their quarterly earnings releases come around. Let's see what the technicals have to say about this one. But they are important. I mean, they're, now that's pretty universal. Look at that. Looks like every decent technical indicator, at least over the course of the last year, is actually bullish on it right now. Where are we? We have a big unfilled gap in here. And how about valuation? Uh, 6.5. Well, yeah, 40 times. I mean, is it worth it? Probably. Are they going to grow their top line at 29-30% next year? Probably. I mean, that is the trend. Like, the CapEx picture right now has not reversed at all. And this is what they have already achieved. So it's not complete pie in the sky. What do we got here for free cash flow? Less than 2%. Yeah, it's a little rich for me. I think AMD. And I mean, I think they're probably going to hit those targets. Give me those events. I want to look at 5-year. See if I can point out it. And let's get rid of the moving averages. And what key events are in? Oops. I only want earnings in my key events. So. I thought I had that clickable icon right here. Well, we can get back to that as soon as it's going to have to give me a second while I remember what the heck was that. What menu do I go into? Oh, whoops, we're after. It's already, somebody just pointed out, it's already over an hour. Okay. So AMD, let's just sort of button this up. It's going to be kind of hand wavy, and I apologize for that. I do need to, what I wanted to do was take a look at 5 years worth of earnings results and the stock's performance leading into and coming out of, because my perception, which I would like to quantify, is that it often runs into these events and then tends to peter out a little bit after. But I have to do a little bit of work on that to get a little bit more concrete. Okay. And let's see if I can, maybe there's one other I can take before we wrap this up. KJ Lemur says, oh my God, I only have 5. I'm assuming you mean screens. You know, back in my Canada days, I had 10. So I had 4/4, and then I had 2 wing ones. And, you know, part of that was because there was some information that I just liked to always have, and I wanted it on a separate box that when I touched any one of the keyboards I've got, because I have 3 keyboards and a bunch of other buttons and switches here, I just wanted to have a couple of screens that always had things I wanted to be able to see at a glance no matter what was going on. So, for example, I always had the S&P futures and a bunch of other things on some major screens, plus my blotter execution. So that means that anything that we were working, tiles would pop up. Like, you just bought this, you just sold that, because I always had working orders out there, and I just wanted to be able to see that. Because when you're doing work and you're doing analysis, if you're staring at a spreadsheet, you probably have it occupying your whole screen, and you're looking at it intently, and even noises, chimes and beeps, I put in custom noises too. So, for example, when orders went off, I queued it up to Rolling Stones, the first bar of Start Me Up. So I would hit, because there's other computers around, there's a lot of beeps and noises, and I needed something really distinctive. Maybe I would have, Jump from 1984 Van Halen, something like that. Something that would really stand out and not sound like the million other beeps, chirps, and chimes that you're constantly listening to all day long. And then it had screens that I would never touch and would just run. So I'd just come in, and those always showed me the same stuff. But the other 8 were so that you could do work. And, when you're using spreadsheets, you have how all of you guys do this, right? You open Excel, and then you've got sheets on multiple places, and you're trying to compare one thing to the other. And this is the reason why they do those little maze games, and you get like some scary picture, and it make these jump scares, because you can really make people focus on their screens, and they just tune everything else out. So the helpful thing for me, this screen over here, this upper one, this thing is actually showing me essentially what you guys are seeing. So I can look over there and kind of see what's going on. So, is it too many screens? Probably. I thought about getting wider curved ones. Those look really cool. But the thing is, if you use worksheets, it's nice to pull a worksheet to a screen and snap it full, right? We all do it. And if I'm constantly moving things around, I don't like that. Well, that was a kind of a little weird segue I just went into that probably wasn't all that helpful for you guys, but I appreciate your patience and listening to me ramble on, because I've just chewed up a full hour, a little bit more actually, almost an hour and 15 minutes. And as always, like, subscribe, hit the notification bell, always put your questions and comments in. I will try to get to as many of them as I can. AMD, I have to do a little bit of homework and just take a look at its pre and post earnings results more quantifiably than this hand wavy stuff I just said. Thanks for watching.